The easiest way by far to learn QuickBooks Desktop is to start your own business. That is why in this tutorial, I'll give you a practical hands-on guide on how to manage a business with QuickBooks Desktop. This way you will be able to understand the concepts better and retain the information easily. For the purposes of this tutorial, you are starting a new business, which is Duncan Designs, a design agency that provides services such as web design, web development, normal printouts, photo editing, and video editing. You have got several high profile clients who rely on your services to market their products, their business, and you have got a few vendors from whom you purchase software, services, and materials to keep your business going. You don't have any employees yet, but you do work with several independent contractors, which are 1099 contractors. After browsing through your options, you have decided to go with QuickBooks Desktop to manage the finances for your business. And now I am here as a consultant to help you out in getting up and started with QuickBooks Desktop as fast as possible. Now that you have QuickBooks installed, you have to set up the company file in order to properly record transactions and organize them so that you can later easily analyze your accounting data and file taxes online. And I have three options here. I can either open a sample company file which already contains a lot of data. I can create my own company file, which is what I'm going to do, and I can also open an existing company file. That is, if I have an existing company file that I created in this version of QuickBooks or a previous one. If you open a company file that was created in a previous version, then QuickBooks will automatically update it so that you can get started using it in your upgraded software. I'll go ahead and create my own company file, and here's a guide that will help you in setting up this company file. You just have to choose the correct options, and for now I'm going to select for myself. You have other options here as well, and if you are moving from Quicken or another accounting software such as Sage 50 or Xero, then you also have that option as well, and then click on Start Setup. Select sign in later. You don't have to sign in immediately, but if you do, it would be easier for you to activate your software and use all of the features that you have subscribed to. I'll choose the name of the company in industry just for the purposes of making this tutorial simple and beginner friendly. I'm going to select other, none, and in business type also I'm going to choose other, none. I can enter the admin email address. It would be easier for me to control the flow of data and the users that I add later on. If I have an employer identification number, which you can get from the government when you start your own business or register it. Once you have entered all the information that you feel is relevant, you can select create company, and QuickBooks will create a new company file for you. I've chosen other and none as the industry and business type for a very simple reason. If you choose any other industry or business type, QuickBooks will create a chart of accounts for you automatically. I don't want that personally in this tutorial because I want to show you how to create your own accounts so that you can get a better grasp of the chart of accounts and general ledger in accounting and QuickBooks. The name of our company appears in the title bar, that is Dunkin' Donuts, and we can see that this is the home page, also known as the dashboard. This provides you a breakdown of all of the features that you will be using. So to manage vendors, you can enter bills and pay bills. You can manage your customers as well. You can create sales orders, which are internal documents that you can use to circulate any order from a customer. Estimates can help you and your customer agree to a certain amount of pricing. The invoice option enables you to record customer purchases made on credit, that is on account, and then you can receive the payment as well, deposit it into your bank account. And if you create a sales receipt, that is the customer pays at the time of making the purchase, then you can create a sales receipt and then record the deposits. On the right hand side, you can see the various company options, that is the chart of accounts, items and services, time tracking, and then you have a few banking features, most important of which are recording deposits, reconciling, and writing checks. As we move on and set up this company for you, I'll give you a breakdown of all of these features and how to use them and when to use them. First off, we are going to customize the user interface in order to improve the overall user experience for our company. We'll go to the edit option and then preferences. And here we have the option to change preferences for our user profile and then the preferences for company file. In my preferences, it is really important for you to turn off these pop-up messages for products and services, because otherwise QuickBooks will keep showing you these pop-up messages and advertising other services and products. Buy into it, and you don't want that getting into your hair when you are working on your finances. Click on OK and go back to the preferences menu, and now head over to the reports and graphs tab, and here you need to select the option to refresh automatically. So whenever you update or modify or add a new transaction, all of your reports will be automatically updated. That can come in really handy if you forget to update your reports and you wonder why transactions aren't reflecting appropriately and accurately. I'll again select OK. Also adjust one company file preference, payments option, and in the payments tab, I can deselect the option to use undeposited funds as a default deposit to account. Think of undeposited funds account as a temporary account in which you store the value of all the checks that you collect from your customers, and when you go and deposit those checks to your bank, you transfer the balance from the undeposited funds account to the checking or savings account for your business. Then click on OK, and QuickBooks will restart all of the windows in order to get set up, and we'll click on OK. On the left hand side, we have a really handy toolbar displaying some of the most important options and the most frequently used options. But I want to modify it to, I want the options that I use most often to appear here along with the icons, and I don't really like the sidebar on the left hand side. I'm much more comfortable with it on the top side because it does not eat so much space then. So to do that, I'm going to select the view option and then go to top icon bar. Icons that show up by default, but I don't want them, so I'm going to remove them. I'll go to the view menu and then customize icon bar, and now I'm going to select the top one and simply start clicking on delete. Damn, all of them are gone now. I'll select OK. I'll now go to, now I have to set up QuickBooks according to my own preferences, and you will be doing it according to your preferences, right? So to each their own. And I'm going to add the home page to the top icon bar. How do you do that? It's quite simple. You can go to the view option and then click on add home to icon bar. Now you can see that the home option appears here automatically, and it is because that is the window that you have actively selected. And if you choose another window, the title that appears on that window will appear here. Click on add home to the icon bar and select the label, the description, and the icon. Click on OK, and you have added your first icon to the top icon bar. Or if you are going with the side icon bar, then maybe the side icon bar. In the old saintly days of yore, businessmen would actually record transactions in a journal, and they'd do that chronologically, and then they'd manually transfer those transactions into the general ledger, which contained a list of all of the accounts that a business required to record and organize its transaction properly. This was a very lengthy process, but luckily QuickBooks and other accounting software simplify this process. So instead of using the general ledger and manually transferring the transactions and organizing them, these accounting systems automatically do bulk of the work for you and post them to the appropriate accounts in the chart of accounts. So think of chart of accounts as the general ledger used in traditional accounting. Now setting up your chart of accounts can seem daunting, but if you start thinking like a business owner, then you may find it very intuitive and a very practical exercise in itself. There are a few key accounts that we do require to create first, and to do that I can go to company and then select chart of accounts. I'll also add the chart of accounts to the top menu bar so that I can come back to it and use it as a reference again and again. And I have it here now. I'll go to the account drop down option and then select new to create a new account. Now I have a few options here, and this can seem daunting, but I'll explain it as we go along. We are first going to create an asset account, more specifically a bank account. And I'm going to select continue, and I'll name it checking because it is our business's checking account, and I'll save the account. I'm not going to set up online services, but you can if you want to. That way QuickBooks will automatically import all the transactions from your bank account into QuickBooks Desktop. So now you are going to start your own business. So you need an equity account. More specifically, you need an owner's equity account, which represents the actual value of your contribution to start the business. Click on continue and enter the name as owner's equity and click on save and close. On the 1st of July, you start your business. You invest $1,000 into your business to start it and you store that amount into the checking account for your business. Now, you may think, why not just go with cash or a personal bank account? And the idea here is very simple. You don't want to mix up and entangle your personal expenses and business expenses because that can land you into a whole lot of trouble with the IRS. So to start this business and to record this entry, we have to create a custom journal entry, that is a general journal entry. And I'm going to go to the company option and then select make general journal entries. And here I have the option to create an entry as per the date July 1. The entry number is automatically 1. And here's the thing about QuickBooks, it will remember the last number of the journal entry that you created. So the next one will automatically be incremented to 2. And then the account that I'm going to select, that is the account in which I'm putting in the money, is the checking account. And the checking account is an asset account. And asset accounts are debit accounts. I'll create a whole separate video on this concept and I'll link it up here whenever it is available. You can go and look at it. But for now, just trust me on this and I'll help you understand these concepts with a new and separate video that focuses specifically on this. Now I go and debit the account by $1,000 and I can enter the memo. I'll now select the account that I want to credit because this is double entry bookkeeping and not single. At least two accounts are affected and the total amount debited should be always equal to the total amount credited. If it isn't, there's something wrong with the transaction that you are recording, and most accounting systems will not allow you to record the transaction if the debits and credits columns don't match. I'm going to select owner's equity and then click on save and close. And we have recorded our first transaction. The business is up and running. Throughout using QuickBooks, you will go back and look at a few key reports, and the most important one of those is the trial balance. I'll choose to look at the transactions till now and I'll add the trial balance to the top icon bar, and so the trial balance displays you all of the accounts in your company file along with the balances of the amounts in those accounts. Currently the total in the checking account is $1,000 and the total in the owner's equity account is also $1,000, and the debit and credit side must always be equal. If they are not, you have got an error in your company file and you need to make adjustment entries to fix the problem. You may have also heard about the balance sheet report, which is a key financial statement, and I'll tell you why we are not going to use it throughout our bookkeeping journey. And the answer is pretty simple. The trial balance is actually an external financial statement, an external report that you send to people that don't necessarily work in the business. So this will be the owner or the shareholders and financial institutions such as banks, and you present them these financial statements to show them the health of your business and how is it doing, if it is profitable or not. But and here's the thing, the trial balance lists all of the accounts from the balance sheet and the profit and loss statement in a single place so that you can quickly cross check how the amounts change whenever you post a transaction or modify a transaction. I'll go back to the home menu and in the dashboard I'm going to create two other accounts for your business. Again, in the chart of accounts, let's use the shortcut key Control A and we'll create a new chart of accounts, and let's again use the shortcut Control N, and I'll select the income account because Obviously, whenever you sell products or services, you're going to take money from your customers or clients, and all that money is going to be recorded in the income account. Select continue and enter the name of the account and click on save and close. I also want to enter an expense account. So again, control plus N, expense, continue. And this is the main expense account under which we'll create more sub accounts in order to organize our data more effectively. Okay, so now we have an asset account, which is the bank account. We have got payroll liabilities, but since we aren't going to manage payroll with QuickBooks right now, I'm going to simply make this account inactive so that it does not appear. I'll also make the payroll expense account inactive. I don't want to see these accounts in my chart of accounts or in the reports, so I just make them inactive. This stores these accounts in your company file, but you don't see them anywhere. Okay, so I'm almost done setting up the main accounts for now, and we'll set up the other accounts as we need them. So we'll set up on the fly as we proceed with recording transactions with real world examples, of course, because that is what will help you to understand the topics in QuickBooks Desktop. Your business, of course, has got things to sell. Those things may be products or services. And since you're the owner of a design agency, you're going to create an item in QuickBooks so that you can match the income and expense appropriately and analyze the profit and loss for each of these services. So the first service is the printout. So I have the list of services that your company provides, and I'm going to add all the items from that list. To do that, I can go to the lists option and then select item list. I'll then create a new item, and this is a service item that I'm going to create. The description that you enter here will appear on the sales forms such as sales receipt and sales invoice, and I can enter the per unit cost of this transaction of this item, and I can select the default income account. Well, you can select the default income account to record all of the income that you get from all of the services that you provide. That doesn't necessarily help us in analyzing the data in any way at all. And part of following the accrual accounting basis is to be able to analyze your profits, losses, revenue, and expenses much more easily. So I'm going to create an income account for each of the services that I provide to my clients. The first thing I'm going to do is click on add new. In the income account, I'm going to select the account type as again income, and this is print income, and I'll make it a sub account so that QuickBooks automatically puts it under the main income account. That way I'll be able to view all the income that I gather in one main account as well as the bifurcation of that income. I'll click on save and close, and I'll select OK. I'll quickly create more new items, so control and again, and this time I'm going to create a web design item, and the account that is the income account for this is going to be web design income account, and it is a sub account of income, and click on save and close. Then select OK. I'll also enter the rate here, and the rate is $100. I'll enter the description, and then select OK. QuickBooks has a spell check feature which is really awesome, but I'm going to make a new word for myself right here. And now I have two items. I'll create another one. This is another service, and this one is web development. And the rate for this is $400. And I'll select the account, add new, web development income, and I'll make it the sub account of income account, and then click on save and close. I'll click on OK to save this item as well. The next item is the photo editing service, and again I'll select service, photo editing, and the rate And the rate I'm going to enter $100. In the account, I'm going to create a new one again, and this is going to be the photo editing income account under the main income account, and then select save and close. Okay, and I'll save the photo editing job as well. And I'll go and select, and then again control N, and this is the final item that I have to create for the services that your business provides. And this is video editing service. The price is $300. Okay, what the fuck? And this is the last item, video editing. It is $300, and the account again is video editing income, and it is a sub account of the income account. You guessed it right. And we have created all of the accounts that all of the items that were required and associated them with an income account to make things easier for us and to be able to analyze the data better. I'll click on OK, and the last item is here with us. I'll go back to the chart of accounts, and the shortcut key was Control A, and I can see that within the income account I have all of the other income accounts that I created. We together have set up a few items and accounts that are necessary to initiate the transactions. Now we need to make a few purchases so that we have the items, the equipment, the software to start the business. On January 1st, you purchased a computer and a printer for $200 and $100 respectively. You record them together and you paid using the write check option directly from the checking account. Let's see how to record this transaction. In QuickBooks Desktop, you can head over to Vendors and then the Vendor Center. We are first of all going to create a new vendor so that we can keep track of transactions much more accurately, and we can do that by going to the new vendor option and selecting new vendor. We can enter the name of the vendor. The opening balance represents the amount that we still owe to the vendor. So if there's a previous amount or bill that we haven't yet paid, then we can enter it here and select the as of date, that is the date as of which we still owe the money. I'll explain rest of the options later. For now, click on OK, and we have the first vendor here. Now, since we paid using a check, we can directly go and record a check through the banking menu and select write check. Here I can select the items and I'll create a new item. It is a fixed asset and it is computer and printer. I'll add a new asset account as well. And I'll make it a sub account of a fixed asset account. I can select the purchase description, whether the item is new or it has been used previously. I can enter the cost of the item, and that is $300. And the vendor, I don't have to enter it yet, but let's just say, let's just leave the cost alone as well and select OK. I've purchased it on the 1st of July, and I have recorded the item, and the cost of this item is $300, and I'll click on save and close. And I've recorded a check and a payment of $300. That amount will be deducted from my bank account, and I can see that if I go to the trial balance. Like, as you can see here, the checking account has reduced by $300, whereas the equipment account, which is the fixed asset account we created recently, increased by $300. We also need to purchase a few printing papers for the print job, and we can do that again by going to the vendors option. And this time we are going to enter a bill. Okay, we'll create a new vendor, and this is I don't have any opening balance with this vendor, and I can even enter the billing address and the shipping address for the vendor and then select OK. I've created a new vendor. I also want to create a new item, and that is going to be paper, and the price of it is $1. And the account that it is associated with is a simple asset account, which is the supplies account. I'll click OK. The amount, the quantity that I have bought is 100, and I'll press tab to update the amount and then click on save and close. And I've recorded the first bill, which goes into the accounts payable account. If I go back to the trial balance, I can see that the accounts payable account has increased by $100, whereas the supplies account has increased by $100 too. And the accounts payable account simply that stores the amount that you have purchased from your vendors on account that is on credit. So you owe this money to your vendor, and as you pay off your debts, the amount in this account decreases. Whereas when you purchase on credit, you take on a line of credit, the amount in this account increases. Next, we are going to have to pay this bill, and we have that option here. In the pay bills section, we can go ahead and choose the vendor and then select the bill that we want to pay. And if we want to pay it partially, then we can update the amount here. But I'm going to pay it in full right here. And the method I'm going to use is check, and the payment date is going to be July 15th. The method is check, and I'd rather assign a check number, and I'll have QuickBooks assign the check number so that it can easily keep track and increment check numbers accordingly when I maybe receive or pay my bills. And the first bill has been paid. And now what you should see is that the accounts receivable balance has become zero. That is, we have paid off all of our due amounts to our vendors. And the amount in checking account has also reduced because we have used the checking account to pay off this debt. As a design agency, you also need a subscription of a software, a design software, and for that, you have purchased a subscription of Adobe Creative Cloud for 6 months for $600. You pay the amount upfront. Even though you make the payment of $600, you don't get the benefit from it immediately. And in accrual accounting, you record an expense only when you derive benefit from it, meaning that you have got to match the expense to revenue generated using it. To get through this conundrum, we'll store the advance payment in the prepaid expense account. But before we do that, we need to create prepaid expenses account. Back in QuickBooks, I'm going to go to company and chart of accounts. Then I'm going to create a new account, which is an other current asset account. And you can see that there's a prepaid expense account option, and I'm going to name it prepaid expense. and then save and close. Okay, so now that I have this account, what do I do with it? I've paid $600 for the subscription. I'll go and create an item so that I can track, record the prepaid expense. I can go and create a custom journal entry. And for that, I can go to company, make general journal entries, and then I'll go ahead and select an account to debit. And in this case, I'm going to debit the prepaid expense account. And the prepaid expense account is an asset account, that to a current asset account, because it is going to provide us future economic benefit, and that too in the short term. Future economic benefit is like we'll receive some kind of money or some kind of service from it. And the amount is $600, and we'll debit the checking account because that is what we are paying from. And then we'll save and close. And we have recorded this transaction, and we have in our prepaid expense account $600, and our checking account has also reduced by $600. So we don't have any money left with us. We are going to invest more of our money, and this can happen sometimes. But yeah, that's life, that's business. And as of 15th, the owner, that is you, decides to invest even more money into the business. And for that, you debit the checking account and credit the owner's equity account. And you again invest $500 this time because you don't have a lot of money left. And now you save and close and go back to the trial balance, where you can see that the checking account has increased. So has the owner's equity account, which displays again the total amount invested by the owner into the business. Now here's how we work with prepaid expenses. At the end of each month, we recognize the expense for that month particularly, because we want to associate the expense for that month with the benefit, that is the revenue we generated for that month, so that we can see the difference and calculate the profit exactly for that month. So we have $600 in the prepaid account, prepaid expense account, and at the end of each month, we are going to start recognizing this expense. And how do we do that? It's simple. We create another journal entry. In the company menu, go back to make general journal entries, and this time again create a journal entry, but this time we are going to debit the expense account. And I think I'll create a new expense account so that I can keep better track of, and I'll make it a sub account of the expense account and click on save and close. Now I have a new account, and I'll recognize the expense and I'll debit the expense account, because think of it this way: you credit the owner's equity account to increase it, and any profit that the business generates increases the owner's equity, that is the equity side of the balance sheet. But if instead of profit it generates a loss, then you debit the account that is to decrease it. So any expense that your business incurs obviously eats into the profit. It reduces the owner's equity, and for those reasons you have to debit the expense account whenever you want to increase it. So since we have purchased the asset for 6 months, the amount that we'll benefit from this month is going to be $600 divided by 6, that is $100, and we'll debit the account accordingly. And we are also going to credit one account because this is double entry bookkeeping. And in here we are going to credit which account? Well, you guessed it right, the prepaid expense account. Okay, I didn't want to record it yet. I'll delete it. I'll create it again. No problem. I'll debit the design expense account and I'll credit the prepaid expense account. And now, here's what I want to do. I want to automate this process because I don't want to manually create a journal entry at the end of each month. What if I forget to create one? My books will be a mess. So this is where automation comes into QuickBooks Online, QuickBooks Desktop. And for that, you can click on the Memorize option here, and you can select the Automate Transaction Entry. You can select the name for this transaction. How often do you want this transaction to reoccur? And I want that at the end of each month, and the next date is going to be July 30th, and the number of transactions to record that are remaining is 6. And I can also enter the transaction in advance if I create profit and loss statements or any other financial statements before this particular date. But as I don't, I'll click on OK, and I have memorized these transactions, and QuickBooks will post them automatically. Now let's come to recording transactions from your customers. Whenever a customer purchases something, you issue them a sales form, and this sales form serves as a documentation, as a receipt that you can store as the proof of the transaction. And in accounting, it is very important to do so because the reliability principle states you should only record those transactions that you can back up with an actual receipt or document. When you record customer transactions, the customer either pays you immediately or purchases on account, which is on credit. When the customer pays at the time of the purchase, you issue a sales receipt. And if the customer purchases on account and promises to pay you later, then you issue them an invoice, and the amount is recorded in the accounts receivable account. Okay, so on 1st July, Darth Vader orders a printout of a blueprint for Death Star version 2, and he pays cash. Whenever a customer pays at the time of purchase, as I said, you record a sales receipt. To record this transaction, we'll head over to the customers menu and select create sales receipts. We'll select the customer, and since we don't have a customer yet, we'll add a new one, and we'll input the name of the customer and the opening balance that obviously I told you is the balance that the customer still owes you. And then you can enter all the other information relevant for this customer. If you enter an email address for the customer, you'll be able to send the invoice or sales receipt directly to the customer. You can also store the address, that is the address at which the billing information will be sent, as well as the address at which you want to ship the product. In payment settings, you can select the account number and the account that you want to deposit the amount into, and also you can select the preferred payment method for this customer. And once you have done this, you can click on OK to create the new customer. In this example, we are going to deposit the funds into the checking account directly, and I'll later show you how to use the undeposited funds account to record this transaction. I'll select the date of the transaction and the item that the customer purchased. This is a print job, and the quantity is 10. I'll click on save and close, and QuickBooks will then record this transaction. I can also input the email address for my company. And I've created the transaction. Let's go to the trial balance and see how the transaction was recorded. So the checking account increases by $10 and the income account also increases by $10. Since the checking account is a asset account, we debit it to increase it, and since the income account is a credit account, we credit it to increase it. And we'll also look at other reports in the future as we create more and more transactions. But for now, let's move on to the next transaction. Tyrion Lannister, who needs you to edit a photo for him, comes into your shop. He says that you can invoice the amount to him and he'll pay in the next 30 days. Since the customer is purchasing on account, you have to create an invoice, and to do that, go to customers and select create invoice. Here you can create a new customer, and this is Tyrion Lannister. There's no opening balance for the customer, and the date is July 1st. The company name is, and I'll click on OK. Here are a few options that are really important in an invoice. First is the date of the invoice. Second, the invoice number. You can change it, but I let QuickBooks assign it automatically so that it can keep track of the current invoice number and increment it. If you received a purchase order from the customer, then you can enter that name here to connect the invoice to the purchase order from the customer. And here you have the sales terms, which define the number of days the customer has to pay back the due amount. If the customer does not pay within this number of days, the accounts receivable that you are recording here will become an aging receivable, and you will have to contact the customer to get paid. I'll select net 30, that is 30 days. Tyrion Lannister has to pay back this amount. And one good thing is that QuickBooks will automatically calculate the due date for this invoice and even remind you if you set up reminders accordingly. I'll select the item. This is photo editing. Quantity is 1. The customer message. And then I'll click on save and close. Okay, so what happens in this case? You have recorded an invoice. What accounts are actually affected? First, you have the accounts receivable account that is affected from this transaction. Accounts receivable records any amount that the customer owes you. If the customer purchases on credit, then this is an amount that you will put in the accounts receivable account, and the account is very important. And accounts receivable along with accounts payable is the whole reason why we rely on accrual accounting. So now that we have the invoice created, let's see the trial balance once again to see how and what accounts are affected. So the accounts receivable, as we guessed, has increased by $100. It is an asset account, so it is debited. And the income account, which is the photo editing income is coming from, has also increased by $100. Let's look at another report, the customer balance report. In the reports menu, back to the customers section, we'll look at the customer balance detail report. And in this, we'll find that there's this invoice and the customer name as well. And we have the total balance for this customer, that is the amount that the customer owes us. You can come back to this report anytime you want to see which customer owes you money. Now let's just receive the payment. Tyrion Lannister comes after 15 days, decides to pay you back. You have to receive the payment and record it into QuickBooks. How do you do that? We'll go back to the customers menu and select receive payments. Now we'll select the customer from whom we are receiving the payment, and it's Tyrion Lannister, and all of the open invoices that this customer has with our company will appear here. We'll select the invoice that we want to mark as paid, and we can even change the amount if the customer has paid partially. After seeing all of the options, I'll click on save and close. But one thing I want you to note here is that we are depositing the amount to the undeposited funds account. And this is another workflow that will come in handy, because the undeposited funds account temporarily stores all of the balance that you receive from the customers. So let's say the customer pays via check, you store the amount in the undeposited funds account. And when you deposit the check into your bank account, you remove the balance from the undeposited funds account and transfer it to the checking account or savings account appropriately. I'll click on save and close. Now we are going to record the deposit into our bank account. For that, we'll go to the banking option and select make deposit. We already have a check that we need to deposit, and all of the undeposited checks will appear here, so that's a good thing. And I'll select OK. I'll then select the account that I want to deposit it to and the date of depositing it. I'll select, let's say, 6th of July. And now I'll click on save and close, and I've recorded the transaction. Till now we have seen how to work with sales, receipts, invoices, and deposits. We have also learned undeposited funds and what do they mean for us. Till now we have seen how to work with sales, receipts, invoices, and deposits. We have also learned undeposited funds and what do they mean for us. But just like prepaid expenses, in which case we make advanced payment to our vendors, there are some customers who are going to make advanced payments to us, and that is known as deferred revenue or unearned revenue. And this too has its own separate workflow. And for this, we'll again create a sample transaction and look at what we can do to record these transactions. Okay, so we'll first create the unearned revenue account, which will store all of the value of advanced payments from our customer. We'll go to company. And let's use the shortcut again, Control A to open the chart of accounts and Control N to create a new account. And the income that we are getting here is actually a current liability because we haven't yet provided the benefit to the customer. And so as per the rules of the accrual accounting, we cannot record it as an income. We still owe the benefit to the customer. And so we are creating a current liability account and we'll name it undeposited funds, and we'll name it unearned revenue account and click on save and close. Now we have this account and we are ready to record a custom journal entry. For that, again, we'll go to the company and select make general journal entries. Now we are going to select the accounts. The first account that we are going to select is the checking account, because the customer pays online and deposits the money directly into the checking account, and we'll debit it by $200. And we'll debit it by $200 and we'll credit the unearned revenue account, which again, as I said, is a current liability account, and you credit liabilities account to increase their amount. We'll click on save and close. Okay, we have recorded that transaction. Let's go back to the trial balance and look at what we have here. Unearned revenue account has increased by $200 and so has the checking account. If we go and take a look at but now let's say at the end of the month, we provide the service to the customer. That is, we have provided the benefit. So we need to recognize the unearned revenue as the revenue that we have earned now. For this, again, we'll create a custom journal entry and we'll debit the unearned revenue account to reduce it. Remember we debit a liability account whenever we want to reduce it. And we'll credit one account as well on the flip side, and this will be the income account. And I'll enter the amount. So this is $100, or was it $200? Okay, let me just check it. Okay, so it was $200. So I reduced the unearned revenue account by $200. That is $200. And I also I increased the income account, that is recognize the income, and credit it by $200. And I have recorded the transaction now. The totals of the debits and credits are equal, and I'll click on save and close. So we are done with this concept as well, and we are ready to move on to something else. One final customer report that I want you to look at is the transaction list by customer. And this report is really important because it will display all of the transactions, whether you have recorded an invoice, a payment, or a sales receipt. It doesn't matter. If it is associated with a customer, it will be displayed here. With customers, you also have the option to create credit memos. These are like an IOU to the customer if the customer asks for a refund and you don't actually provide refund. You can create a credit memo so that another invoice in the future for this particular customer, what you can do is apply the credit memo and the invoice amount would be reduced by that amount. For that, we'll go to the customers menu and we'll create credit memos, refunds. We'll select the customer for which we are creating the credit memo. And we'll select the item and the amount of refund, amount of credit that we are giving to the customer. We'll click on save and close. We'll retain it as an available credit so that we can apply it on a later invoice, and we'll select OK. So let's say customer again comes back and asks for a service. This time Darth Vader wants us to make a video for him, and he'll use the video to recruit more stormtroopers. And once I have recorded this transaction, QuickBooks will display that the customer has a credit memo available and that I can apply it here to this very transaction. And I'll select yes to apply the credit, and I apply the $1 credit and select done. And I can see when I go back to the customer reports and select customer balance detail report, I can see that there's a credit memo applied to an open invoice for this customer. Okay, so we are done with all of the main customer transaction types and we are ready to move to something else. But what? Let's look at a few other key reports here. Next, we'll take a look at estimates and sales orders. Both of these are very important because a lot of times you'll receive estimates or purchase orders from your customers. So when do we create an estimate and when do we create a sales order? We create an estimate upon a customer's inquiry. If a customer wants to know the total cost of a job, we'll send them an estimate and they can reply back that they want the order to proceed, and then we can create a sales order with that estimate. And the sales order is an internal document that we circulate in our own company to tell other employees what the customer has ordered and what the expectations of the customer are. The estimate can be turned into an invoice or a sales order, but the sales order can only be turned into an invoice directly. Sales orders serve as a middle ground between the invoice and the customer's order. Let's say if the customer orders something and you do not have that item, then while creating the invoice you can use the sales order to specify and note all of the items that you have and the total amount of those items. So I'll create a sales order and an estimate to give you a brief example. In customers menu, go to create estimates, select the customer, select the item that you want to create the sales that you want to include in the estimates, and then click on save and close. Now you can see, however, that there are two options here. That is, you can create an invoice from this estimate or create a sales order from this estimate. We'll click on save and close for now. And we also have the option to record a sales order, and I'll select the customer and I'll enter the item. Now this sales order is something that I'll use as an internal document to circulate inside my office, right? So I'll give it to my employees or my freelancers so that they can create the amounts appropriately, so that they can do the job appropriately and prepare the order for the customer. I'll click on save and close. And I've recorded the transaction, that is the sales order, and now I can send it to other employees in my organization. Apart from the key reports that I've shown you till now, there are a few other reports that you need to come back to again and again. And these reports include the accounts receivable aging report, the accounts payable aging report, the general journal report, and the audit trail. Head back over to reports, and in accountant and taxes, you can select the journal. You can select the date as per which you want to see and you can see all of the transactions written down here. Whether you used any option to record the transaction, it will appear here. And this is very important whenever you are looking to find out any errors in your books. To see behind the scenes how QuickBooks has recorded the transaction, you will use the journal report. Next, we'll head back to the reports menu, and this time we are going to take a look at the audit trail, which is frighteningly essential for all of the businesses that have multiple users accessing their company file. And to find the audit trail, we'll go back to the the reports menu, and I'll go to the accountant and taxes section and select audit trail. The audit trail displays all of the actions that all of the users who have access to the company file have taken. Now this is a great way to find out if someone has made an error, then who was it. If someone decides to delete all of the company finances as a prank, then you can see the user activity here and recognize who this user is. All activity taken, whether recording a transaction or paying a bill, everything is recorded in the audit trail. Next, we'll look at the accounts receivable aging report, and for that we'll go to reports and AR aging detail. We can see in the AR aging detail all of the customers who have an open invoice with our company, that is, they haven't paid their dues, and if the invoice has passed the due date, then the accounts receivable becomes an aging receivable, and in this case you can reach out to the customer and demand that they pay you back. However, if the customer declares bankruptcy, that is, does not pay you the amount, then you record a bad debt, and that's a whole different topic that I'll cover in a different video, and I'll provide the link of that video whenever it is available. And finally, we'll look at the accounts payable report, accounts payable aging report, and this is the amount that we owe to our vendors. And an aged accounts payable is one that is beyond its due date and we need to pay it as soon as possible so that we can maintain a good relationship with our vendors and suppliers. Okay, so now you have recorded all of the transactions. But why? Why even record these transactions, and what do you do with all of this data that you have worked so hard to record in your company file? There are three main uses of this data: to keep a record of your transaction, for tax preparation purposes, and for analyzing the financial data of your business. Once you have prepared the closing entries for the particular accounting period, what you can do is create key financial statements that give you better insights into the performance of your business. And these financial statements are actually meant for the owners, stakeholders, and external institutions so that you can secure more funding, prove the performance of your business, or even secure loans from financial institutions such as banks. But right now we are going to look at the three key financial statements: the balance sheet, the profit and loss statement, and the statement of cash flows. The balance sheet gives you a snapshot of a business's financial performance at a given point in time. It is basically the accounting equation in an expanded tabular form. What you need to make sure is that the amount that the business owes is equal to the amount that the business owns. So the total amount of assets must be equal to the sum of the total amount of liabilities and total amount of equity. And for this purpose, I'm going to use a sample company file. Okay, I'll go back to the reports menu, and this time I'm going to select company and finances and then the balance sheet standard account. So you can see that the balance sheet is divided into different sections. We start off with assets. Assets are things that will provide us with future economic benefit. That is, we are going to get some value out of them. These are things that we own. Current assets generally provide benefit within the current financial period, that is within the next 12 months. And you have cash and cash equivalent accounts at first, which is the checking account, savings account, petty cash. And then that is followed by non-cash accounts, that is the accounts receivable, which shows the total amount that a customer owes to you. You have the undeposited funds account that you have stored temporarily. These are the checks that you have stored temporarily and haven't yet deposited into your bank. You have the inventory. If you are a merchandising manufacturing company, then you can store this. Then this will be the value of the total inventory that you have. Let's get to the fixed assets. These are long-term assets such as plant, property, and equipment that your business expects to derive value from in the long term. So this includes things like vehicles, equipment, land, and the accumulated depreciation is a contra asset account. So it has the opposite balance of an asset account. The depreciation actually reduces the value of an asset over a period of time, and all the depreciation applied to fixed assets is stored in the accumulated depreciation account. You have some other assets as well, which is a security deposit, and then you have the value of total asset. Now we'll come to this value back once we are done with the other sections. The liabilities section shows you the amounts that you owe to people outside your organization. Accounts payable is short-term liability. You have to pay it within the next 12 months, and it is the amount that you owe to your vendors. Then we come to the credit card liabilities. So you have to pay the credit card bills, and if you have taken a line of credit from your bank, then that will also go into the accounts payable account. In other current liabilities, you have the amount that you need to pay to your employees, the amount that you need to pay in federal and state taxes. Now let's come to the long-term liabilities, which are liabilities that you have to pay over multiple financial periods. So these would be notes payable, that is the loan that you have taken from a bank or any other financial institution. And finally, you have the equity accounts. The equity section shows you the amount that a business owes to its owners and shareholders. You have the opening balance of the equity account, which is the balance from the previous year. You have the capital stock, you have the retained earnings, and then the net income. The retained earnings are part of the previous year's profits that the business has still retained for its own use. So it has not distributed this as a dividend, or the owner has not withdrawn it. We can see that the total liabilities and equity are equal to the total assets over here. And that means that our books are balanced and we don't have to actually go in and find out if there's an error. From here, we are going to go and look at the income statement because that is where we get the net income from. We'll go back to the reports section, company and finances, and select profit and loss standard. And you can see that the net income isn't the same as the one in the balance sheet, but that is because of our mistake. We haven't selected the same reporting period for both of these. Since the balance sheet is for fiscal year to date, we need to select the same option here, that is fiscal year to date. And once we have selected the same options for creating these reports, we'll see that the net income is the same in both of these reports. If I just put it side by side, you can see that the net income here, which is a little more than $113,000, is the same as the net income in the profit and loss statement, which is also known as the income statement. Let's take a look at the income statement. We first take the total revenue for the year. So if I minimize this, and this is the total revenue that our business has earned. The cost of goods sold is the cost of sale, and that includes the total amount that went into production in providing product or services to your customers. And we reduce the cost of goods sold from the income account to get the gross profit. And this is the first type of profit we have in this account. And from the gross income, you have to simply reduce the direct and indirect operating expenses, which include things like fuel expense, salary payables, administrative costs, etc., and depreciation and amortization to get to the operating profit. And once you are done with that, you can reduce the amount of taxes you have paid and the interest expenses on loans that you have paid to get to the net income, to get to the net ordinary income. And finally, from there, you add income from the other sources that are not the main sources of income for your business to get to the net income for the defined time period. And finally, we come to the statement of cash flows. Let's go back to the reports option, company financial, and select statement of cash flows. The statement of cash flows takes the net income from the profit and loss statement, that is the income statement that we looked at just before this report. And what we do is we remove all the non-cash transactions from it. At the end of this report, we want to see the total, the net inflow and outflow of cash. And to do that, we need to reverse all of the transactions that don't result in an inflow or outflow of cash. So these transactions can be things like accounts receivable. Accounts receivable increase the net income of your business. However, they do not increase the amount of cash that your business received. So we'll remove that. We'll remove the total amount of assets that we have. And we'll also add back all of the accounts payable, which we recorded as expenses. They reduced our net income, but in this case, they did not lead to any cash, to any change in the balance of cash. So again, we reverse that transactions. We then adjust, and then we see what is the net cash flow from the operating expenses. And then we see the net cash flow from operating activities, which are activities like marketing, distribution, manufacturing, and sales. So these are the main activities of your business. You then reverse these entries and get to the net cash provided by operating activities. Then you look at the net cash from investing activities. Investing activities are things like investing in plant, property, and equipment, or selling plant, property, and equipment. These aren't the main source of income for your business, so they go into a different set of activities. And you can see here that the company has purchased furniture and equipment, and that has led to a cash outflow, and so we reduce the amount of cash here. Next section is the income from financing activities, and financing activities are directly related to raising funds or paying back loans. So if you raise funds from your owners, stakeholders, or take a loan from a bank or pay off the loan with cash, then you record that here. And once you have noted all of these values, you get net cash increase for the period, and you can actually reconcile the cash flow statement using the balance sheet. You need the balance of the cash account from the previous year and from this year, and the difference there should be the same as the amount of net cash increase for period that is displayed in the cash flow statement here. If the amounts don't balance, there's something wrong. So this is it for now. This is all that you needed to know to get started with QuickBooks Desktop and to manage a business or to manage accounts for another business using this amazing software. I've also included several practice exercises in this tutorial so that you can actually get a hands-on experience of how to record transactions and analyze financial statements. At the end of this video, you'll also find a list of resources that you can go to learn more about specific types of transactions and to even practice analyzing financial statements. If you like this tutorial, subscribe to our channel and hit the like button.